One of the joys, if you could call it that, of being in lockdown is that you get to catch up on all the reading that you're supposed to be doing. One of my hobbies is to collect research papers, put them into a very, very neat pile, and then put them in an area of my desk where I don't actually see them. Unfortunately, lockdown has defeated this little tactic because having had nothing to do for several weeks other than clean and tidy my desk, they're now in plain view. So with that in mind, a few weeks ago I cracked them open and began to rummage through them. And one of the ones that intrigued me the most was this wonderfully titled working paper called Persistent Bias in Advice Giving. What it does is it looks at the notion that if you offer an inducement to someone who gives financial advice to recommend an inappropriate investment to someone, then even when the inducement is removed, the bias to do so remains. There is a persistency over time. What this group did was got two groups of advisors, and they gave them three investment alternatives. The investment alternatives for both groups were the same. Option A, as we will see, is noted as the most risky of the alternatives and is only really appropriate for the most risk-seeking of investors. For the second group, they offered them an inducement. They said, if you recommend this investment, you will get a bonus, knowing full well that it was inappropriate. They then found something interesting when they looked at the results. As you would expect, in the group that were offered no inducement, a better judgment prevailed. Just under 4% of advisors recommended the inappropriate investment to the group. In the second group that were offered the bonus, just under 55% recommended it, despite knowing that it was inappropriate. So at best, we could assume that the advice is inappropriate. At worst, we can assume it's immoral. But where it sits upon that spectrum is up to each person to make a judgment. Me being somewhat cynical will drop it in the immoral basket. But the experimenters did something very interesting. They then removed the incentive and repeated the experiment. And they got this. Remember, the group who had the bonus are not being paid a bonus in this trial round, but their behaviour persists. They continue to make the same investment recommendation despite not being compensated for it. As you would expect, the no bonus group doesn't alter much at all. So this raises the question as to why this behaviour occurs. And the authors of the paper give it away a little bit in their introduction. And this is a piece I've snipped out of it. And it says, to avoid a negative and immoral self-image, biased advisors can perceive their recommendations as those which they actually should have recommended had they actually been impartial. However, when advisors morally accommodate their corrupt behaviour in such a manner, they also have to stick with their advice. The reason is that changing it, in particular when the conflict of interest disappears, would signal to themselves that their initial advice was corrupted and therefore that they acted immorally. In many ways, this is this notion of you've made your bed, now you have to lie in it. But what's happened is that if advisors were to offer a different investment on the second run round, then it would set up an internal tension, a dynamic within them that they could not resolve psychologically or emotionally. Their self-image that they hold so dear would begin to unravel, so they have to stick with this persona. So once this sort of supertanker of immoral behaviour is set in train, it looks as if it cannot be course-corrected in any way, shape or form. And the authors of this paper make that note when they say that experienced advisors who have spent their hitherto professional life in an environment which featured such incentives, that is, you are paid a commission to recommend things that might be crap, will likely exhibit persistent biases in their recommendation. So that means that if you've been in this industry and that has been your mode of recompense, then it is probably almost impossible for you to change behaviour. That raises the question as to whether a generational change would alter the behaviour at all. My cynical answer, once again, is probably not. And it is probably not because of the way the industry is structured. You see, people within the finance industry are not paid on performance as we know it. Brokers are people who sell second-hand goods. They're selling you a tarnished product. And they're paid on the number of those tarnished products they sell you. Granted, the remuneration mechanism has changed a little bit since I was in the business, but it still has the same basic focus. But what I want to do is to try and wrap this into some of the behaviour I've observed over the years and see if we can't tease out some sort of rationale as to why people have behaved in the way they have. And the classic example I want to use is Enron. If you are unfamiliar with Enron, Google it. And if you are unfamiliar with Enron and have to Google it, stop trading, please. Because you're not a student of the market. And you don't understand that history repeats. And it repeats over and over and over again in the market. So every new shock, every new silliness is brand new to you. You are the ultimate naive investor. I'm fond of saying that to be a successful trader or investor, you must be a student of the market. You must understand your place in history. Because if you don't understand your place in history, you'll simply be one of the fools that repeats it. And history repeats itself with glorious incompetence. On the screen at present, I've got a little schematic, and I've got 4 parts to it. Across the top, you'll see a series of dates. Down the left-hand side, you'll see a series of names. These are the names of broking houses, investment houses in the US, who had Enron within their advisory purview. It was in their environment to look at. Along the bottom, I have the price of Enron, and I've correlated that with the dates at the top so they match up. In the centre, you will see the different coloured bars. These represent strong buy, hold, strong sell. They are the broker's recommendations at various points in time. For those of you who are unfamiliar with Enron, a quick précis. Enron was set up as a giant financial scam. It had no other purpose than to defraud people. That was its mode of operation. This eventually began to unravel when people eventually began to catch on. But as we'll see, some people caught on much quicker than others, and some never did. And so there's a timeline across the top. The timeline is used to anchor certain events. On October 16, Enron reports a massive third quarter loss. Now note the price at this time. Price is oscillating between, from 2 weeks before, 33.10 to 33.84. And you can see that it is still a buy, or a strong buy, among all the houses. Next day, Enron shrinks its shareholder equity by 1.2 billion. You'll see that strong buy persists. There's been no change in tone or tenor. Later that day, the Wall Street Journal reports upon the massive executive fraud that has been going on within Enron. You would think that that in and of itself would begin to trigger a change in tack, but it doesn't. Granted, it is only 2 days, but investment moves very, very quickly. These houses are quite nimble. It takes no time to print a briefing note that says, we now recommend this as a strong sell. On October 23, Wall Street Journal reports the SEC probe. So they've gotten wind that there is already a probe underway into Enron. And you'll notice here things do start to change a little bit. A.G. Edwards have moved to considering it a hold. Even in my days in broking, I had no idea what the hell hold meant. You're either a buyer of a stock or a seller. You don't hold it. But you'll see there's only been 2 broking houses that have changed. The rest are either buy or strong buy still. So they're still persisting. Their bias from earlier times persists. On October 31, the SEC formally announces its investigation. But let's have a look at the share price. On our first note, on October 16th, share price was $33.84. Come the end of the month, 2 weeks later, October 31, the share price is just under $12. It has completely cratered itself. But even this event, combined with what is occurring in the regulatory environment, has not prompted a great pivot shift in broking recommendations. Your expectation would be that across the board you would see strong sell, but you don't. You see 2 strong sells, you see a suspended, which is code for, let's just friggin' hope that nobody remembers we recommended this. But you've still got buy, strong buy, strong buy, buy, strong buy, strong buy, buy, strong buy, hold. That word again. Prudential has a strong sell. Smith Barney has a hold. UBS Warburg has a strong buy. And in fact, UBS Warburg had a strong buy right up until the time that the stock had lost 99.9% of its value. It then became a hold. So to put this in the context of the time, this is the period that little tablet covers. You can see that the share price had already halved. So you have an environment whereby share price has halved, company is under criminal investigation that Wall Street is aware of, but none of these houses change their recommendation. And you have to ask the question as to what is the role of a stock analyst? If it is not to make a judgment call about the health of an individual organisation that is being recommended. The best explanation of what is a Wall Street analyst that I could find was from the humorist Dave Barry, who says that Wall Street relies on stock analysts. These are people who do research on companies and then, no matter what they find, even if the company has burned to the ground, enthusiastically recommend that investors buy the stock. This is Enron. So this raises the question as to why does this occur from a corporate point of view? Well, a little bit of background. In very generic terms, stockbroking or investing houses, and I'm not talking about trading houses, are divided into 2 arms. The first is corporate advisory. Corporate advisory is immensely profitable. And what corporate advisory does is literally what its name suggests. It handles capital raisings, new listings and the like. It even offers advice to external businesses. Although why anyone would take the advice of someone who worked in a stockbroking firm is friggin' beyond me. My experience was that they were the worst run businesses in the world. The second arm is the sales arm. This is where you see stockbrokers. Stockbrokers, as I said, are purveyors of second-hand goods. So let's go back to our notion of corporate and our advisors. Corporate advisory is tremendously profitable. It brings in staggering sums of money. But when we have bull markets in full swing and there are mergers and acquisitions and new listings and corporate raisings, some of the fees from these events are in the hundreds of millions. So let's assume you're an analyst beavering away at one of these firms, and one of the firms that gives your company tens of millions of dollars in fees you find to be shit. What do? Do you front up and say to the sales arm, look, you have to start ringing your clients and telling them this company is rubbish? Or do you simply do as Dave Barry suggests, that you continue to enthusiastically recommend that investors buy the stock, even after it is burned to the ground? What you will find, and what some of the evidence already presented indicates, is that most will opt for the notion of continuing to enthusiastically recommend the stock. And in a moment or two, we'll see reasons as to why that might be. But in terms of the generic look of advice. Here are some things to think about as a thought experiment, to think about as, in the world of common sense, could this be true? Now, I say the world of common sense because when it comes to financial markets and the like, common sense seems to disappear. So this is from a paper called Experts on Whose Behalf? And it found, according to Thomson Financial / First Call, 50% of all recommendations are buys, but only 1% of all recommendations are sells. So let's put that in context. Let's use our common sense and say, in an index like the ASX 100, is it possible that 50 of those stocks are buys, but only one is a sell? But let's put this into further context. Let's play a game. Let's imagine you go into a clothing store and you say, I'm looking for a piece of clothing. And they say, fine, we've got a stock full. Do you go, 50% of those are brilliant? No, one's rubbish. I look stupid in that. That doesn't happen. You go into a shoe store. Do 50% of all sizes fit your feet? No, I don't think they do. Bret Barber did some work on this as well, and he tracked the change in ratios over time, over a 6-year period from 96 to 2002. In 96, he found that 60% of all recommendations were a buy. This number had lifted to 74% of all recommendations in 2002. Interestingly, and it is only interest for, it looks like a quirk, 4% of all recommendations were a sell in 1996. I think that probably overstates it. And 2% of all recommendations were a sell in 2002. I would probably consider that that's more likely to be the generic figure across the board for this period. But I mentioned the notion of analyst compensation and performance and termination. And this paper looks at the ratio of buys to sells as a function of analysts' fear of being terminated. And you'll see over time that the ratio of buys to sells increases. But at the same time, analysts' anxiety about their termination and their performance and their compensation on their performance also increases. So we go back to that notion I said before of you can't really, as a young analyst in a firm, come forward and say a company that is providing massive income for your stockbroking firm is rubbish. And so what do? You toe the company line. You fall into step behind someone else. And, as the original paper showed, once this behaviour kicks in, and once it is richly remunerated, it persists. There's no way to fix it. So where does this leave the average investor? Well, I actually believe the average investor should approach every piece of advice that they're ever given with regard to finance with this in mind. An investor might expect advice that is free of both psychological bias and self-interest. Instead, they discover belatedly that the advice is a mixture of wishful thinking and self-serving hype. If you go into every meeting and every phone call with a financial advisor, with a stockbroker, with a fund manager, with this in mind, you have a safety net. And for those of you who don't know where this clip is from, this is from The Wolf of Wall Street. The Wolf of Wall Street is the best documentary on Wall Street you will come across. It's not really meant to be a documentary, but it is. So how do you overcome this? What mechanism should you use? Well, it's really quite simple, but it's not easy. Learn to do your own thinking. Again, if a broker rings you up or says to you, buy ABC, bring up the chart of ABC, and if you can't see a clear uptrend from the back of your room, move on. But I mentioned before the notion of being a student of the history of markets. This is from 1955, and it's a critical look at Wall Street. It's called Where Are the Customers' Yachts? And it's one of the books I recommend to everyone. It asks the question as to why aren't stockbrokers' clients wealthy? Nowadays you could ask the question of hedge funds and high-frequency trading groups. Why is it that the people who run the hedge funds make the hundreds of millions a year, but the people who invest in the hedge funds don't? And so we come back to this notion that if you are not a student of the market and you don't understand motivations, if you don't understand what drives people's behaviour, then your investing will perpetually be on the back foot. You will always be behind the curve because everything will be new to you and everything will be a surprise. And the only way you overcome that is by putting down the books that have all the nice pretty squiggly lines on them and actually start reading books that matter.